Hi guys, my name is Erin Miller and today I will be doing my presentation over Marriott International and their financial statement analysis. So to begin, we have that Marriott International is located in the United States and internationally, including Mexico, Europe, Paris, the Caribbean, and all over the world. They are the largest hospitality player in the world with 176,000 employees. They mainly work as a lodging operator and franchisor, and their largest competitors in strictly the hotel industry are Intercontinental Hotel Groups, Wyndham Worldwide Corporation, Choice Hotels International, Hyatt Hotels Corporation, and the Hilton Hotels and Resorts. For the industry analysis of the hotel industry, it is actually one of the fastest growing industries in the world. And it's mainly because this generation is spending their disposable income on travel, tourism, and luxury. So the industry is very large as is, but it's expected to continue to grow as they continue to market to millennials as well as the older generation. So the business model for Marriott, they use an asset-light model. So they're able to manage and franchise the hotels rather than owning them. So this brings about some competitive advantages, including pricing power, and this is mainly just because they are the #1 company in the industry. And then they also have significant switching costs for property owners and long contracts, so they have more control over their property owners. And all of this comes together to allow them to have higher returns on capital, which they can then reinvest into the company. So next we have the firm's history, and they were started in 1927 in Maryland, and Marriott started as a senior living community company and more of a distribution center. But in 1998, when they acquired the Ritz-Carlton, they were able to move from this senior living community to more of a hospitality company. And then in 2016, with the acquisition of Starwood Hotels, it gave them access to international markets. So now we're going to start on the financial statement reformulating. So this gives us a better idea, and it gives investors a better idea of the health of the company. So first we have the balance sheet here that's been reformulated. So we separate our operating assets from our operating liabilities, and we've separated out our net financing obligations. Then we have the income statement, which separates the operating income from the operating expenses and our net financing expenses. And both of those allow us to calculate our financial ratios, which gives us an overall picture of the health of the company and their financials. So the top three are our profit margin ratios, and they overall give us they show us that Marriott's in very good standing. It shows us how much income is coming from their sales. And then the next two are capitalization and our financial leverage. They more need to be compared with other companies in the industry. And comparatively, Marriott is doing very well. And then operating profitability, because it's a positive percentage, this just means that they are creating a profit. And then financing profitability, because it's very low, it doesn't cause any red flags with their financing costs. Next, we're going to look at some different valuation models to determine the intrinsic value of the firm, to determine if it's a good investment or not. So first we have the comparables model here, which looks at the top 5 competitors with Marriott, and then it kind of estimates the value of Marriott based on its competitors. So the top 3 are highlighted there in yellow, but because you can see there that the book value was negative, so we weren't able to calculate a price to book ratio. So I added in the top 4 and 5 competitors as well. So you can see down there in green, the intrinsic value of the firm comes to $47 billion. And this I do not feel is an accurate representation of the value of the firm, because if you look at Marriott's sales earnings and shares outstanding compared to its closest competitors, those numbers are vastly different. So while it's true this one, intrinsic value versus market value, shows us that it's a bad investment, I don't think it's a good starting point for us to continue on with our valuation models. So moving on to our discounted cash flows model, we have, in order to determine the proper growth rates, I looked at what the analysts were expecting for Marriott's growth rates over the next 5 years and used those in our calculation. So this brings us to a firm value of about $67 billion, which I do believe is a much more realistic value for the company. And it then shows us that our intrinsic value per share is $191.28, which compared to our current stock price of $142.55, this is a good investment and our current stock price is underpriced. Moving on to our residual earnings model. Again, our analyst expected growth rates are used to bring us to an intrinsic value of $156.28 and a firm value of $53 billion. This one shows that our intrinsic value is greater than our current stock price, making the current stock price underpriced. But I do believe that we are continuing to get better valuation models as we go. So this one's even better than the discounted cash flows and so on. Lastly, we have the residual operating income model. So this uses our numbers from our reformulated financial statements and the growth rates from our analysts. And then additionally, for the net operating assets, I had to calculate another growth rate. So I used the stockholders' equity growth rate over the last 10 years. And this was very inconsistent. So I used it as kind of a springboard to estimate my own growth rate, which was -7%. Although it's important to understand that this is not going to continue on for forever. So after 5 years, it would be a good idea to change this up a bit. But this brings us to a value of the firm, or a value of common equity of $52 billion, and our intrinsic value per share of $153.28, showing that our current stock price is underpriced. Lastly, my recommendations for investors. So even though the company does have really high growth rates, it doesn't always mean that the stock price will grow alongside these growth rates. And because Marriott is #1 in the hotel industry, the market will most likely grow alongside Marriott, which could cause the stock price to act differently than the growth rates. So I recommend that investors hold and wait to see how the market reacts to these growth and then react to that. And the NASDAQ analysts also suggest that investors hold their stock. Thanks for watching and have a good day.